Well, part of the answer may be that markets often react later than people expect. Think back to 2020, early in the year, first signs of global pandemic, cities closing in Italy, hospitals overwhelmed, international travel shutting down. Now, markets initially shrugged it off, but then on 20th of February 2020, global markets suddenly collapsed. Over the next 5 weeks, the Dow Jones fell by around 30%. Similarly, in 2008, the housing crisis had been building for years, subprime mortgage defaults were rising, and house prices had been falling for over 2 years. Yet markets just drifted down slowly. It was only after the dramatic collapse of Lehman Brothers and images of employers leaving the building carrying boxes that markets really panicked. On the 29th of September 2008, the Dow Jones fell 7% in a single day. So financial crises often appear slow and manageable until suddenly they're not. Now, another risk bubbling under the surface of the economy this year is rapid growth of private credit and private equity. After the 2008 financial crisis, banks became far more heavily regulated. So investors started to look for higher returns, shifting money into less regulated areas of finance, like private equity. And these sectors have grown dramatically over the past decades. But recently, there have been signs of stress. BlackRock has limited withdrawals from some of its private credit funds due to illiquid assets and weak returns. Private equity valuations have fallen significantly from their recent peaks. And the industry faces what analysts call a maturity wall, around 162 billion of debt needing refinancing this year. But that will be at a higher interest rate than the previous decade of ultra low rates and all that cheap, easy money because the Fed expanding its balance sheet. So in some respects, you could say the situation does start to sound uncomfortably familiar to those early stages of the 2008 crisis. Though, of course, there also are significant differences. Private equity has problems, but not the extreme leverage and the level of bank exposure that we had in the credit crunch of 2008. But the economy still faces many new stresses this year. Oil prices really do influence inflation.